President Donald Trump announced a significant 50% tariff on foreign steel imports during a rally at U.S. Steel's headquarters in Allegheny County, near Pittsburgh. This move comes as part of efforts to bolster domestic steel production and protect U.S. steelmakers from international competition. The announcement also highlighted a partnership between Japan's Nippon Steel Corporation and the United States Steel Corporation, underscoring a collaborative approach to strengthening the U.S. steel industry. The imposition of such a high tariff is expected to have a substantial impact on the global steel market, potentially increasing the cost of imported steel and providing a competitive advantage to domestic producers. This protectionist measure is likely to benefit U.S. steel companies in the short term by boosting local production and employment. However, it may also lead to higher prices for industries reliant on steel, such as automotive and construction, potentially affecting consumer prices and economic growth. The move reflects ongoing trade tensions and could invite retaliatory measures from other countries, impacting international trade relations.
The Federal Reserve's preferred inflation measure, the Personal Consumption Expenditures (PCE) Index, showed a significant cooling in April, rising only 2.1% year-over-year, down from 2.3% in March. This marks the lowest level since September, providing some relief to markets unsettled by ongoing U.S.-China trade tensions. Core PCE, which excludes volatile food and energy prices, increased by 2.5%, also marking its lowest point in over 4 years. The cooling inflation figures have led traders to anticipate a potential rate cut by the Federal Reserve in September, as the central bank continues to monitor the economic impact of tariffs and inflationary pressures. The backdrop of these developments includes heightened trade tensions, as President Trump accused China of violating a tariff agreement, intensifying the trade war that has affected global markets. Despite these tensions, the Dow Jones, S&P 500, and Nasdaq saw only slight declines, reflecting investor optimism that the Fed may ease monetary policy. Meanwhile, consumer spending growth slowed to 0.2% in April from 0.7% in March, possibly due to consumers rushing purchases ahead of anticipated tariff impacts. This spending pattern, combined with a court ruling deeming many of Trump's tariffs unlawful, adds complexity to the economic outlook, as businesses like Walmart and Best Buy signal potential price increases in response to the tariff landscape.
Canada Pension Plan Investment Board, CPP Investments, and Encino Energy have sold their stakes in Encino Acquisition Partners to EOG Resources for $5.6 billion United States dollars, including debt. Encino Acquisition Partners, established in 2017, was designed to acquire U.S. oil and gas assets, with CPP Investments holding a dominant 98% share. This transaction represents a significant divestment for CPP Investments, aligning with its strategic realignment and recent policy shift away from a rigid commitment to net zero emissions by 2050. This move reflects a broader trend among institutional investors to balance sustainability goals with financial returns, allowing for more flexible investment strategies in response to evolving market conditions. The sale is part of CPP Investments' broader strategy to optimize its $36.3 billion energy portfolio, which includes renewables, conventional energy, and emerging technologies. With total assets under management exceeding $700 billion, CPP Investments' decisions are closely watched for their implications on portfolio diversification and long-term growth strategies. The transaction is expected to bolster EOG Resources' presence in the oil and gas sector, particularly in Ohio, potentially influencing market dynamics and investor sentiment. This profitable exit underscores CPP Investments' focus on adapting to market dynamics while navigating the complexities of sustainable investing.
Strathcona Resources Limited has launched a formal takeover bid for MEG Energy Corp., offering 0.62 of a Strathcona common share plus $4.10 in cash per MEG share. This bid, set to expire on September 15, 2025, is being reviewed by MEG's board and a special committee of independent directors, with shareholders advised to wait for a formal recommendation within 15 days. The move is part of Strathcona's strategy to strengthen its position as a leading pure-play heavy oil company, following its divestiture of Alberta shale natural gas assets for $2.84 billion and acquisition of the Hardisty crude by rail terminal for $45 million. Both Strathcona and MEG specialize in steam-assisted bitumen extraction in eastern Alberta, making their operations complementary. The bid is financially supported by a $662 million equity commitment from MEG Energy Fund, which owns nearly 80% of Strathcona's shares, demonstrating confidence in Strathcona's future growth. The market reacted with Strathcona's shares rising over 2% to $29.42, while MEG's shares fell nearly 2% to $24.53, yet trading above the bid value. This suggests investor anticipation of possible counteroffers from larger oil sands companies like MEG Energy, Canadian Natural Resources, or Imperial Oil. The situation underscores the competitive dynamics within the Canadian oil sands industry as companies maneuver for strategic advantage.
The U.S. housing market is experiencing a significant shift towards a buyer's market, as indicated by a recent analysis from real estate brokerage Redfin. In April, the number of home sellers exceeded buyers by 490,041, marking the largest disparity since Redfin began tracking this data in 2013. With sellers outnumbering buyers by 33.7%, the market dynamics have changed notably from a year ago when the gap was only 6.5%. This shift is particularly pronounced in metropolitan areas such as Miami, Austin, Phoenix, and Nashville, where sellers vastly outnumber buyers, making these regions strong buyers' markets. Despite the increased supply of homes, Redfin predicts only a modest 1% drop in home prices by the end of 2025. This is partly because home prices are typically resistant to significant declines unless sellers are compelled to sell rapidly. The National Association of Realtors recently reported a 1.8% year-over-year increase in median home sales prices, reaching $414,000. However, the number of home sales fell by 0.5% from March to April, reflecting the impact of high mortgage rates, which currently average 6.94% for a 30-year fixed-rate mortgage. While some areas like Newark, New Jersey, remain sellers' markets, the overall trend suggests a more favorable environment for buyers in the coming months.
HP Inc., HPQ, experienced a significant stock decline of 10% this week, closing at $24.56, following a mixed second-quarter earnings report that failed to meet expectations. While the company reported revenue of $13.22 billion, slightly above analyst forecasts of $13.15 billion, it posted an adjusted earnings per share (EPS) of 71 cents, missing the anticipated 80 cents. CEO Enrique Lores cited strong commercial performance in the personal systems division, but highlighted challenges arising from a dynamic regulatory environment, including increased costs due to U.S. tariffs. The company has revised its earnings guidance for the third quarter to a range of 68 to 80 cents per share, falling short of the 90 cents forecasted by analysts. Additionally, HP reduced its full-year earnings outlook from $3.45 to $3.75 to $3 to $3.30 per share. The earnings miss and downward revision in guidance have prompted a cautious shift in analyst sentiment. J.P. Morgan has adjusted its price target for HP from $30 to $27, maintaining an overweight rating, while Barclays lowered its target from $36 to $28, reiterating an equal weight rating. This has resulted in HP shares trading near their lowest level since early 2023. The company's performance and outlook reflect broader challenges in the industry, including regulatory pressures and cost implications from tariffs, which may influence investor sentiment and strategic positioning within the information technology sector. Investors seeking exposure to HP can consider options such as exchange-traded funds, ETFs that include HP within their holdings, as these can provide diversified exposure to the sector's trends.
Canopy Growth Corporation's stock experienced a significant decline, plummeting 20.5% during Friday morning trading following a disappointing earnings report. Analysts had anticipated a loss of 20 cents per share for the Canadian cannabis company's fourth quarter of fiscal 2025. However, Canopy Growth reported a staggering loss of $1.32 per share. This substantial earnings miss has raised concerns among investors about the company's financial health and strategic direction. Despite the poor overall performance, Canopy Growth attempted to highlight positive aspects of their report. CEO Luc Mongeau emphasized a 4% year-over-year increase in Canadian sales and a 13% rise in Canadian medical cannabis sales. He also pointed to improvements in adjusted EBITDA and cash flow as evidence of progress toward profitability. Nevertheless, the company's global sales fell by 11% in Q4, and free cash flow remained negative at $36.2 million for the quarter, totaling a negative $176.6 million for the full year. The firm's ongoing challenges in reversing negative sales growth and cash flow issues continue to cast doubt on its near-term prospects, leading to a bearish market sentiment.
Middleware technologies are increasingly pivotal in transforming financial systems, as highlighted by Venkatesh Keta. These technologies act as the crucial link between disparate financial systems, significantly enhancing operational efficiency and security. Financial institutions utilizing advanced middleware have reported up to a 47% improvement in transaction processing efficiency and a 72% reduction in system downtime. This efficiency is vital for managing the rising demand for real-time processing and secure data transmission. Middleware also plays a crucial role in safeguarding operations by implementing robust security protocols, achieving up to a 94% success rate in preventing unauthorized access. Additionally, middleware's scalability allows it to handle increasing transaction volumes without compromising performance, which is essential for high-frequency, high-volume transactions. Beyond operational improvements, middleware has a profound impact on financial inclusion, particularly in underserved regions. Middleware-enabled services have expanded access to banking, contributing to a 32% increase in financial service accessibility and a 45% rise in digital banking adoption rates. This has resulted in a 28% increase in formal banking participation in previously underserved markets. The integration of artificial intelligence, AI, and machine learning, ML, with middleware is driving further innovation. AI-powered middleware solutions have improved transaction processing efficiency by 42% and reduced system latency by 37%. Moreover, AI-driven security measures have led to a 56% reduction in security incidents. These advancements not only enhance system security, but also contribute to operational efficiency, making financial services more accessible and affordable. As middleware continues to evolve, it is poised to shape the future design of financial services, driving economic growth and customer satisfaction.
The Financial Services Institutions Bureau, FSIB, has recommended Ashish Pandey and Kalyan Kumar for the roles of Managing Director at Union Bank of India and Central Bank of India, respectively. This decision follows a rigorous selection process involving 23 candidates, assessed on performance, experience, and other criteria. Pandey, currently an Executive Director at Bank of Maharashtra, is set to succeed A. Manamakalai at Union Bank of India. Meanwhile, Kumar, who serves as the Enforcement Directorate at Punjab National Bank, will replace M.V. Rao at Central Bank of India following Rao's retirement in July. The FSIB, led by former Department of Personnel and Training Secretary Bhanu Pratap Sharma, plays a crucial role in nominating key leadership positions within state-owned banks. The final appointment will be confirmed by the Appointments Committee of the Cabinet, overseen by Prime Minister Narendra Modi. This transition in leadership is significant, as it could influence the strategic direction and operational efficiency of these major public sector banks, potentially impacting their market performance and competitiveness in the Indian banking sector.
A significant legislative development in Texas has seen the failure of a tort reform bill, SB 39, in the House committee, despite its earlier passage in the Senate. The bill was a high priority for the trucking industry, which viewed it as a critical measure to address perceived imbalances in trucking-related lawsuits. The bill's failure to advance is a setback for proponents seeking to limit the legal liabilities faced by trucking companies in the state. However, the industry still has hope with another active piece of legislation, SB 30, and its companion bill, HB 4806, as the legislative session nears its end. The tort reform efforts are part of a broader push by the trucking sector to mitigate the financial and operational impacts of litigation, which can lead to increased insurance costs and operational disruptions. The outcome of these legislative efforts could have significant implications for the trucking industry's legal landscape in Texas, potentially influencing operational costs and risk management strategies. As the legislative session concludes, industry stakeholders will closely monitor the progress of the remaining bills, which could shape future legal and financial frameworks for trucking companies operating in the region.